Now let's take things a step further and look at strategy number 2, where we combine two time frames for even better trade precision. In the higher time frame, we apply the same concepts discussed previously, with only one difference. We zoom into a lower time frame to add confirmation and execute the trade. This strategy is not limited to any specific market or time frame. However, your entry time frame should be 2 times lower than your higher time frame. Here are 3 time frame combinations you can use, depending on your trading style. For example, if your higher time frame is the 4-hour chart, you would drop down to the 15-minute chart to execute the trade. So let me show you how it works. In the first step, identify the trend and mark potential supply and demand zones on the chart. Also, check the higher time frame market structure to see how much room price has before reaching the next important level, in order to avoid entering a bad trade. Next, wait for price to retrace back into your trading zone. Never enter a trade before price clearly reaches our demand zone, because the market often sweeps early entries and uses them as liquidity for the main move. Once price reaches the supply zone, we zoom into the lower time frame to look for confirmation and then enter the short trade. Here on the lower time frame, we have a clear uptrend, which represents the correction leg of the higher time frame. What we want to see is that price begins to respect the supply zone. In other words, we need to see rejections from this area, or any signal that the lower time frame uptrend is starting to reverse. You can use many types of signals as your entry trigger for a short trade.